My name is Satoshi Kono, Executive Vice President of Raccoon Holdings, Inc. Thank you for taking the time to gather here today. In today's presentation, I will be walking you through the results for the third quarter year-to-date of the fiscal year ending April 2026. Let's begin with today's agenda. First, as usual, I will start with a review of the financial results for the third quarter of the ongoing fiscal year. This will be followed by an update on the progress and future priority measures within the scope of the business alliance we formed with Advantage Partners last November. Third, I will be outlining the company's 5-year vision, detailing Raccoon's desired future state for 2031. Lastly, I will briefly discuss the recent changes to our dividend policy. Let's start with the third quarter financial results. We recorded 4.811 billion yen in net sales and 974 million yen in operating income, up 5.5% and 2.3% respectively on a YOY basis. Looking at top-line growth, please note that while we are reporting a 5.5% increase, this figure is impacted by the exclusion from consolidation, that is, the divestiture of our former rent guarantee business, effective November 1st, 2024. This naturally creates a structural headwind for YOY comparisons, so adjusting for this impact, and as noted in the footnotes, net sales actually grew by 10.3%, reflecting continued double-digit momentum in our remaining businesses. Looking at sales across both the EC and financial businesses, the biggest driver this quarter, which I will detail further later, was our domestic operations in the EC business. As you know, GMV is the product of the average sale per buying customer and the total number of purchasing customers. Historically, we have faced challenges in raising the average sale per buying customer, but this metric saw substantial improvement in the third quarter, growing 10% and 15% on a YOY and QOQ basis, respectively. This drove double-digit growth in domestic GMV, which was up 12% and 13.3% on a YOY and QOQ basis. This was the single most relevant sales catalyst in the third quarter. Conversely, and to be honest with you, international GMV continued facing headwinds from the Trump tariffs. In the financial business, both Paid and Uriho continued posting strong double-digit growth, but with a relevant caveat, as Paid's acquisition of major member companies fell short of expectations. This is an area we will be improving upon moving forward. Turning to the bottom line, operating income reached a new record high of 974 million yen, marking our highest ever quarterly profit. As you may recall, our profits temporarily surged during the pandemic, driven by special demand for face masks. Surpassing this one-off COVID-era peak represents a significant milestone and is highly encouraging news for the company. Allow me to give you a bit more color on the numbers. Circling back to what I said earlier, we recorded 4.811 billion yen in consolidated net sales, 3.987 billion yen in gross profit, up 7.7%, and 974 million yen in operating income, which represents 2.3% growth. There are two specific headwinds impacting operating income this year that I want to highlight. First, we launched a shareholder benefit program for the first time this fiscal year, resulting in 46 million yen in newly recognized costs in the second quarter, an expense we didn't have during the comparable period last year. Second, as noted in the results briefing for the second quarter, we absorbed significant shipping cost overages in our international e-commerce segment during the first half of the year. Specifically, in terms of the breakdown, we recorded headwinds of 30 million yen in the first quarter and 20 million yen in the second quarter, which negatively impacted operating income. However, I want to emphasize that this shipping issue was fully resolved in the third quarter, where we actually saw a 4 million yen positive recovery. I will detail the specifics of this recovery in a moment. While this third quarter turnaround stabilizes this trend, the 50 million yen cumulative impact from the first half remains a drag on our year-to-date operating income results. I would now like to briefly highlight our income statement, excluding advertising and sales promotion expenses. As these figures remain largely consistent with my earlier comments, we invite you to review this table at your convenience later. Turning to the trends in Group GMV and Uriho's guarantee balance, these figures serve as key indicators of our expanding reach within the SME market. Quarterly Group GMV, which combines super delivery and paid volumes, net of any overlap from buyers using paid within the super delivery platform, has officially surpassed the 20 billion yen mark. Concurrently, Uriho's guarantee balance, which represents the credit risk we manage for our SME clients, stood at 71 billion yen at the end of the third quarter. Under our Raccoon B2B network medium to long-term vision, we aim to aggressively expand this reach, and, as the network scales, we expect Group GMV to grow significantly, making this a critical indicator for our trajectory moving forward. Looking at our year-to-date cumulative results, consolidated net sales, excluding the rent guarantee business, grew by 10.3%. Specifically, the EC business grew 7.6% YOY in the third quarter, while the financial business, again excluding the rent guarantee business, maintained strong double-digit growth at 14.6%. The quarterly trends remain robust, with EC sales reaching 997 million yen and nearly touching the 1 billion yen milestone. While gross profit from the EC business grew in tandem with sales, gross profit remained largely flat in the financial business, primarily on account of the normalization of default-related expenses, which effectively function as our cost of sales in this business. Following unusually low default costs in the second quarter, which drove higher margins, third quarter defaults have returned to the historical baseline, resulting in flat QOQ gross profit despite strong 14% top-line growth. SG&A expenses in the third quarter were primarily driven by the other expenses category, which totaled 788 million yen and includes approximately 46 million yen associated with our new shareholder benefit program and approximately 50 million yen in higher overseas shipping costs in the EC business. While this shareholder benefit program is indeed a recurring semi-annual expense in the second and fourth quarter, we view the shipping overages in the first and second quarters this year as non-recurring anomalies linked to external factors like the Trump White House's ongoing tariff environment. Uncertainty remains on this front, but we do not expect this dynamic to persist indefinitely. Let's now look at operating income. Third quarter operating income reached a record high of 399 million yen. As noted earlier, this cumulative figure remains largely flat year over year, as it still reflects the first half impact of overseas shipping overages and our new shareholder benefit program. Looking at the quarterly trend in operating income, the third quarter was an exceptionally strong period for profitability growth. Specifically, operating income reached 399 million yen, representing a robust 31.8% QOQ increase and setting a new record high for the third quarter. While we were just shy of the 400 million yen milestone, this is still a very strong result. This sequential acceleration was driven primarily by strong top-line growth in the EC business, and the fact that our previous shipping headwinds have now completely subsided. All in all, we are very pleased with this growth trajectory. Let's now turn to the summary by segment, starting with the EC business. Here, we recorded a segment profit of 934 million yen on 2.838 billion yen in net sales, while our GMV KPI grew by 9.5% to 22.416 billion yen. While this consolidated figure is slightly below our full-year target, looking at the geographic split provides important context. Specifically, domestic GMV continued to achieve growth, slightly surpassing the full-year target, driven heavily by a 10% increase in the metric of average sale per buying customer. While growth in the number of buyers in Japan was somewhat soft in the third quarter, we have a clear path to recovery that I will detail shortly. Conversely, overseas GMV is tracking below target. Here, the impact of the US tariffs is indeed proving to be substantial, and as anticipated, this has resulted in a gradual decline in our international buying customer count in certain countries, especially in the United States. That said, average sale per buying customer overseas is accelerating even faster than in our domestic operations in Japan. Thanks to this strong per-user spending, overseas GMV still achieved nearly 7% growth despite the lower buyer volume. Lastly, the shipping cost dynamics for this segment are as I outlined earlier. I would now like to take a closer look at our domestic performance. As you can see in the KPIs on the left, the number of buying customers grew 1.8% on a YOY basis, while the average sale per buying customer surged by 10%. If you look at the table on the bottom right, you'll note that the average sale per buying customer has historically been a challenging metric for us, with sequential YOY declines of 15.5%, 8.7%, 1.8%, and 8.5% throughout fiscal year 2025. In fact, negative or anemic growth lingered through the first and second quarters of fiscal year 2026. Given the sudden 10% spike in the third quarter, I want to proactively address why this happened, since there is a series of clear, identifiable reasons behind this strong recovery, and why we expect it to be sustainable. Historically, we have utilized our point reward programs and coupons as top-of-funnel levers in EC, focusing heavily on driving customer numbers, by, for example, re-engaging dormant users and new user accounts. Then, in the third quarter, and with an eye toward optimizing our marketing ROI, we significantly shifted this strategy. We temporarily dialed back acquisition-focused coupons to optimize our promotional budget and redirected these coupons to incentivize a higher average sale per buying customer number among existing buyers. This targeted approach was highly effective, directly driving the aforementioned 10% expansion. Given the clear success of this strategy, we intend to maintain this promotional model focused on optimizing the basket size moving forward. On the flip side, growth in the number of buying customers decelerated significantly in the third quarter as a direct result of our dialing back on acquisition-focused coupons and point reward program incentives. Moving forward, our objective is to recalibrate the balance between user growth and growth in the average basket size. By driving simultaneous growth in average sale per buying customer and in the number of customers, we expect to create a strong compounding multiplier effect on our total GMV. I would now like to discuss our results in the international EC business. As noted earlier, various headwinds caused a decline of 4.4% in the number of buying customers, this gradual decline being most pronounced in the US market. Fortunately, this was counterbalanced by a very strong 13.5% expansion in the average sale per buying customer. Looking at regional performance, Taiwan posted a GMV growth rate of 6.9%. While Taiwan's growth rate historically exhibits some volatility, ranging from 1 to 2% to around 10% growth, it remains consistently positive, so we are pleased with this quarter's 6.9%. The US market remained largely flat as tariff impacts weighed on customer acquisition. Additionally, as we have previously communicated, we have deprioritized our marketing investments in the Hong Kong market, which explains this GMV contraction of 18.9% in the region. Conversely, South Korea continues on a highly favorable trajectory, delivering strong 19.5% growth. Beyond these markets, we are heavily focused on the EU. Here, while we do not disclose country-by-country breakdowns, France is a good example of our focus on and traction in the region. Following the launch of local language ads and YouTube campaigns, France delivered massive 81.9% YoY GMV growth. On a consolidated basis, the EU is now approaching 10% of our total GMV, compounding at an annual rate of over 50%. As a region, the broader EU market now rivals the scale of our established markets like the US, Hong Kong, and South Korea. Moving to the trends in super delivery GMV, you can clearly see the significant expansion in our domestic market. I want to draw your attention specifically to the charts on this slide and the next. The bar chart illustrates the sudden, substantial third quarter surge in transaction value per customer. The overlaid line graph tracks the number of retailers, which we break down further on the next slide. Looking at the breakdown, we recorded strong first-time purchaser numbers, as effective top-of-funnel promotions drove a rebound in new buyer volume starting in the third quarter and returning to robust first quarter levels. Conversely, returning purchaser volume saw a slight contraction, although this was the result of our strategic pilot to reallocate point rewards and coupon subsidies toward driving the value of transactions per customer, rather than retention. Circling back to what I said earlier, we intend to once again strike the right balance between customer acquisitions and basket size in the coming quarters, and we expect repeat purchaser growth to resume its upward trajectory starting in the fourth quarter. Let's now take a closer look at the trend in the value of transactions per customer, which we expect will continue growing up and to the right moving forward. As you can see on the chart, this expansion was broad-based across our customer segments. The value of transactions per customer continues to grow in the international category, while the category of domestic retailers saw the most dramatic acceleration, showing a steep upward trajectory. Even the category of other than domestic retailers, which is historically flat, saw an uptick in the value of transactions per customer. In summary, basket sizes expanded across the board. Please review this sales graph at your convenience. It tracks closely with GMV. Looking at segment profit on the left, the EC segment delivered a record high quarterly profit in the third quarter, reflecting growth in domestic GMV and improvement in overseas shipping costs. This concludes our overview of the EC business. Allow me to transition to the financial business. The financial segment delivered a segment profit of 620 million yen on 1.973 billion yen in net sales. Breaking down the top line, you can see that Paid and Uriho grew 15.2% and 14.2% respectively. Excluding the impact of the sale of the rent guarantee business, our core operations achieved 14.6% double-digit growth. Looking at the KPIs, Paid's transaction volume grew 11.3%, and Uriho's guarantee balance expanded by 14%. While this represents a solid, steady expansion, we still slightly underperformed our targets. As the paid transaction volume chart indicates, we maintained strong double-digit growth, but our acquisition of major member companies fell short of our expectations. Re-accelerating these enterprise acquisition efforts will be a primary focus area for us going forward. Turning to Uriho's guarantee balance, which saw significant expansion, with the total balance growing 18.9% on a YoY basis. Breaking this down, our core subscription-based guarantee category grew 24%, while the non-subscription category grew 4.5%. Because our priority is expanding recurring subscription revenue, these results, while slightly below our most aggressive targets, clearly underscore our strategic focus. This graph shows the trends in sales on a quarterly basis. The light-colored bar at the top represents our legacy rent guarantee business, which left the scope of consolidation in the third quarter of fiscal year 2025. In the third quarter, sales from our remaining operations have finally surpassed our peak revenue levels prior to the sale of Raccoon Rent. I would now like to go over the trend in the cost of sales, which is a function of costs associated with defaults. Earlier, I noted that despite double-digit sales growth, the cost of sales in the financial business was virtually flat, and this slide illustrates why. In the second quarter, the default rate was exceptionally low, buoyed by a favorable review of provisions, and temporarily boosted margins. In the third quarter, the cost of sales has returned to the historical baseline, creating a slight sequential margin compression. That said, I want to emphasize that our current 23.4% default ratio remains at a low level. Ultimately, this demonstrates the ongoing improvement in our structural profitability and the continued discipline of our underwriting standards. Let's now turn to the final portion of our financial results, which covers the segment profit results for the financial business. Because the cost of sales remained stable, operating income saw a very slight decline, meaning it remained essentially flat overall. That said, factoring in second and third quarter results, we believe our operating income baseline has now structurally stepped up from past levels. The financial business, in particular, benefits from predictable recurring revenue. As such, by executing disciplined promotional strategies, driving customer engagement, and maintaining strict control over our default rates, we believe this model will allow us to yield stable compounding profitability. This concludes the financial results overview. Shifting gears, I would now like to touch on our business alliance with Advantage Partners, which we entered into in November 2025, and through which we are currently collaborating to drive robust business growth. I would like to use this opportunity here today to review the details of this business alliance and provide an overview of our current progress and future priority measures. First, allow me to reiterate the strategic rationale behind this business alliance. Our objective is very clear: to realize the Raccoon B2B network, which is our company's medium to long-term vision. While this naturally involves growing our three core businesses of Super Delivery, Paid, and Uriho, we partnered with Advantage Partners specifically to ensure the funding and management resources necessary to execute this vision. Allow me to review the core premise behind the B2B network, first by determining what unites Super Delivery on the e-commerce front and Paid and Uriho in the financial business. Our overarching goal across our three businesses is to optimize and streamline operations by SMEs nationwide. Generally speaking, SMEs tend to face a diverse array of structural challenges, including labor shortages and a lack of IT or financial expertise. By leveraging our resources, we aim to solve these pain points by providing a service ecosystem that enables SMEs to operate more efficiently. Raccoon B2B Network is premised on the understanding that SMEs require a much broader array of services to navigate their diverse challenges. So our objective is to build a comprehensive network ecosystem that delivers these solutions. As we expand our service lineup, we will actively execute M&A and either make minority investments or forge strategic partnerships depending on the circumstances. By broadening our offerings for SMEs, we will drive cross-selling across the network, and this is our strategy for Raccoon B2B Network. We currently have over 500,000 corporate accounts on our platform, and By pursuing M&A and minority investments, we will systematically expand this account base and drive cross-selling across the ecosystem. As I mentioned at the beginning regarding Group GMV, our goal is to proactively scale this metric. This concludes a bird's eye view of our strategy for Raccoon B2B Network. Within the scope of our current initiatives with Advantage partners, our primary focus is accelerating the growth of our existing businesses. In the EC business, we are actively testing and implementing strategies to strengthen sales and marketing while further scaling our overseas operations. We are executing a parallel strategy in the financial business. Alongside broad-based sales and marketing expansions, we are actively strengthening our enterprise sales structure to capture larger corporate accounts. As I noted earlier, our approach to large enterprises with paid requires recalibration, and we are committed to strengthening this area to generate robust cross-selling. On a parallel track, we are working with Advantage partners on M&A and minority investments, which tie directly into the long-term vision of our B2B network. On a personal note, having collaborated with Advantage partners over the past 3 months, my sincere takeaway is the caliber of their professionalism. Raccoon already possessed data analysis and KPI management capabilities, but Advantage Partners operates in a whole different league, so we are currently absorbing and integrating these capabilities into our own management practices. This alliance is thus proving to be a very positive transformative catalyst for our company, fundamentally elevating our operational governance and creating a bridge to talent pools and external networks, which we fully intend to leverage moving forward. This slide details our efforts to strengthen sales and marketing. Circling back to what I said earlier, we remain committed to strengthening existing businesses. We invite you to review this slide later at your convenience for a more detailed breakdown. On the M&A front, Advantage partners will collaborate with us across the entire life cycle, including sourcing, due diligence execution, and the PMI process. We have just recently entered the sourcing phase. Historically, we have carried out 2 M&A transactions over the years, the first one being the 2010 acquisition of NIS Lease, now Raccoon Financial. The second was the 2018 acquisition of Raccoon Rent, the rent guarantee business we divested last year. Raccoon Financial is now one of the 2 core pillars that underpin our operations, and thus represents a highly successful acquisition. Conversely, the rent guarantee business did not succeed, as we were ultimately forced to sell this business last year. Reflecting on this outcome, we recognized there were shortcomings in our initial sourcing analysis and subsequent PMI execution, so we seek to leverage Advantage Partners' expertise to shore up these specific capabilities, as we believe that doing so raises the likelihood of success in our future M&A endeavors. This concludes the overview of our alliance with Advantage Partners. I would now like to discuss our desired future state for 2031. While this pivot may seem a bit abrupt, we recently issued a press release outlining this long-term strategy. First, let me start by clarifying the strategic significance of using 2031 as the reference year. As noted in our recent press release, we are officially retiring the current midterm management plan on the basis of the fundamental transformation of our business environment and operating structure, following our alliance with Advantage Partners. We intend to unveil a new midterm management plan in June 2026, alongside the full-year results for the fiscal year ending April 2026. To clarify the timeline, the new plan will encompass the 3 fiscal years ending April 2027, 2028, and 2029. As such, our vision for April 2031 extends our strategic goals of full 2 fiscal years beyond the end of the updated MTMP. The significance of the year 2031 is that it aligns with the conclusion of Advantage Partners' investment period. We first defined our ideal corporate state for 2031, and are now working backwards, breaking that vision down into our new midterm management plan and the earnings forecasts for fiscal year 2027. Rather than focusing on the quantitative metrics today, I want to outline our qualitative vision for 2031. Naturally, Raccoon B2B network will be fully operational and significantly larger by 2031, and it will have evolved beyond our current core offerings of super delivery, paid, and Uriho into a comprehensive ecosystem featuring a wide array of services tailored to the operational needs of SMEs. We anticipate our current base of 500,000 accounts will grow into the millions. The ultimate vision here is an environment where millions of SMEs seamlessly utilize the services within our network to optimize their operations. Once this vision becomes reality, we believe our platform will have dramatically improved conditions for SMEs throughout Japan. The Raccoon Group currently operates under a three-company framework. Raccoon Holdings oversees Raccoon Commerce Inc., which manages our EC operations, and Raccoon Financial Inc., which oversees the paid and Uriho businesses. Looking ahead to 2031, we expect to incorporate several additional network participant subsidiaries, alongside multiple equity method affiliates, and a more expansive portfolio of minority investments. In alignment with this vision, we have formulated our quantitative targets, which we announced earlier today. Specifically, we are guiding for 13.5 billion yen in net sales, which is equivalent to a forward-looking CAGR of 15%. We're also targeting 4.3 billion yen in EBITDA and 4 billion yen in operating income. While EBITDA is not currently a disclosure item, our clear strategic commitment to pursuing M&A means we will begin reporting it alongside operating income starting next fiscal year. It is important to note that these figures do reflect some anticipated M&A activity, but because we do not yet have full visibility into the exact volume or scale of these future deals, we have taken a conservative approach to these estimates. As such, highly successful M&A execution would present further upside to these numbers, as would any significant progress on the cross-selling front and its associated financial benefits, which we have by and large excluded from the forecast. Based on these projections, our valuation models suggest a target share price of around 1,800 yen, placing our anticipated market capitalization at the 50 billion yen mark. While we are currently trading at a PE multiple of around 15, this 1,800 yen target is calculated on a fully diluted basis, which assumes Advantage Partners exercises all warrants and convertible bonds. So this implies a future PE ratio estimate of around 20 times earnings. Assuming we execute our strategic plan as outlined, we believe this is a realistic and compelling valuation target. Lastly, allow me to discuss the changes to our dividend policy. While categorized as a change, it is more accurately a time-bound expansion of the existing framework through the fiscal year ending April 2029. Our basic policy, consisting of a consolidated payout ratio of between 45 and 50%, remains unchanged. However, for the 4-year period through fiscal year 2029, in other words, for the duration of the new MTMP, we are introducing 2 enhancements. First, we are implementing a progressive dividend policy, which establishes a floor for our payouts. We expect to distribute an annual dividend of 22 yen per share for the ongoing fiscal year, and this 22 yen level will serve as the baseline minimum for the next 3 years, providing shareholders with some downside protection. Second, we are introducing what we've termed a profit-linked additional dividend. Under this commitment, if our profits increase significantly, we will incrementally raise the payout ratio on that upside. Specifically, for any net income generated between 1.2 billion and 1.5 billion yen, the payout ratio on that specific portion goes up to 60%, and for any net income exceeding 1.5 billion yen, the payout ratio on that tier increases to 70%. As such, our updated framework consists of our basic policy, enhanced by a progressive dividend floor and a profit-linked additional dividend. At the same time, we have discussed our commitment to active investment, particularly in M&A, in collaboration with Advantage partners. Some investors may potentially view this strategy as a direct trade-off with our focus on enhanced shareholder returns. However, our business model is highly cash generative, characterized by upfront cash inflows, and our financial models confirm that we can comfortably fund substantial investment while simultaneously strengthening our shareholder returns, all thanks to these strong cash flow dynamics. This dual capability is precisely what enabled us to expand our dividend policy today. This concludes my presentation. Thank you for your time today.